Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that boost your trading potential. Coming up after a blockbuster year for the TSX, is the rally about to hit a pause? Lightwater's Jerome Haas with us here in studio is going to break down why caution may be the word of 2026. Plus, he's going to tell us where investors still might find some opportunities, from gold and the banks to overlooked Canadian mid-caps. And in today's technical take, we're taking a closer look at SanDisk, which has been on fire this year. We're going to see what the charts are saying and whether there's more upside to come. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We are half an hour into the trading day. Let's check on the S&P 500. Yesterday's sell-off started with Oracle, some concerns about AI data centers, their usual financial backer, sort of spread to some of the other tech names, but we are bouncing back today, up about 1% right now in the S&P 500. We got that first U.S. inflation report since the U.S. government shutdown ended. Consumer prices rose 2.7% at an annual rate. While that is above target, it was lower than the street was expecting, and investors liked the sound of it. We got a nice pop in the S&P 500 out of the gates. Let's check in on the heat map. I want to see how those tech stocks are doing today after causing us trouble yesterday. Not too bad. You got NVIDIA, Microsoft, Broadcom, Google all showing some modest strength. Apple sort of the outlier there, down about 1%. Want to take a look at Micron if we're talking about tech. It is a beat on the top and the bottom line for its most recent quarter. A nice strong forecast from the chip maker. They make memory and solid state storage chips, both in high demand. There's my people over there, and short supply because of artificial intelligence. Let's take a look at Lululemon as well, athleisure maker of athleisure wear. Pop more than 6% in the early going right now. What is going on? There's a report out there saying that Elliott Investment Management has taken a stake worth more than $1 billion. They are known as activist investors. Just earlier this month, CEO Calvin McDonald announced he was stepping down in the new year. That also put a little wind underneath the stock, because it has been lagging some of its competitors, both in terms of sales, and the stock price has been lagging as well. A little excitement as perhaps a refresh for the brand. And that's your market update. All right, joining me now from London, Ontario, my colleague here, and Amin from our direct investing educational team. And in studio, we have Jerome Haas, portfolio manager with Lightwater Partners. Great to have you here with us, Jerome. We're going to have a great chat. Just a reminder to our viewers before we jump into that, the views and the forecasts expressed are solely those of Jerome and his team at Lightwater Partners and based on their research. Jerome, I want to start with the TSX Composite Index. When we look back on 2025, it's had a great performance considering what we thought could have been, particularly in April. Yep. When we had all the tariff and all that drama there. We still got slow growth. We still got risk out there. What do you think the markets are underestimating for 2026 for this market?
Well, you know, the reason why we were all concerned in April is Trump tariffs, and I don't think that's gone away. We forget that CUSMA is going to be renegotiated this year, or sorry, next year, and I suspect that's going to rattle the markets. You know, Trump's going to pretend that he's going to walk away from the deal to try and get as much concessions as he can. But if I was, you know, holding shares of a manufacturer, I'd think twice about holding it into those negotiations, because it's going to cause unrest in the market and uncertainty, which investors don't like.
Don't like unrest, don't like uncertainty. When I think about the Canadian economy right now, the Bank of Canada, TD Bank's own forecasters are expecting growth, but very modest growth. This is a consumer in this country, and, you know, a homeowner is very sensitive to rates, probably more so than the U.S. What do you think about that in terms of coming through to equity risk?
Well, I think the Canadian market is slowing down. Whether or not we slow down more than the American market remains to be seen. But I do think a cautious tone, as you mentioned in the intro, is appropriate going into 2026. And I think you know, consumers are going to be pausing in Canada and in the States. I think that we have to be cautious about that aspect as well. But you know, when you look at the stock market, there's really nothing that is an obvious catalyst to pull it down, other than, you know, rumblings about CUSMA.
Talk about the catalyst that could be there. I just looked at the Schiller ratio for the S&P today, just hit about 40. It's the second time it's hit that level since the dot-com bubble. I know by your own words, you say valuations are stretched by any standard. So in the context of the market cycle, is this a classic late cycle setup, or is there something structurally different that's happening for today's multiples?
Well, we don't spend a lot of attention on those kinds of metrics, but I will say in looking at some technical analysis, which again is not our forte, but we do attend conferences and listen to others' views on that. I think we're in the 7th inning of the market rally, so there is more upside ahead. But the question is, when we start to get to the 8th inning, when does the market start discounting that? And so the market's very forward-looking, but I would say we're in the 7th inning.
Okay, so let's talk about the 7th inning and possibly the 8th inning. When you talk about specifically the sectors that we have in Canada, which ones are working right now, and what are they telling you about our economy?
Well, number one that's really driven the market this year has been the financials. I mean, if you owned any of the banks, you're up a minimum of 40%. If you own TD Bank, you're up 70-some% this year, which my mom and I actually bought PA. I wish I would have bought it for the funds, but we basically don't buy any banks in our funds. It's been a fantastic year, but where do you go from there? I mean, you're probably looking at, if consensus figures are right, about 7% growth in the bank. We're trading about 14 times for the bank, which is at all the banks, which is about 10-year highs for them. So you're not going to get a revaluation like we got this year. You're probably just going to get 7% growth. So 7% upside from here, I'm not sure I see the risk return on banks, but Canadians love their banks as investments. So I don't think anybody's going to be selling on my recommendation.
Now, when I think about the banks, I mean, it is a core holding of a lot of Canadian investors in their portfolios that has had a great year. It's hard to see where it goes from here. Outside of the banks, sometimes people will bring up the life cos when they're talking to me about financials because they often get overlooked. I think they've had a pretty strong year as well.
They've done very well, and what's interesting is we own one of the insurance companies, which is Fairfax, and Fairfax trades at a significant discount to the life cos. So you get Sun Life, and even Manulife has been re-rated by the markets in the last 2 or 3 years. It was the dog for the longest time. But you've got Fairfax at 1.2 times book. You've got Sun Life at about 2.4. I'd much rather own Fairfax at 1.2 times than Sun Life at 2.4. And I think there are opportunities in the market like that to look at stuff that have been laggards that are still at reasonable valuations. And I think that's where you make your money in 2026.
What's the risk for a name like Fairfax? You say just based on where it's trading, it looks attractive compared to some of its peers, but where could things perhaps not work out for Fairfax?
Well, they have a lot of market exposure, and so if the markets pull off, then it's likely that they will roll back in sympathy with that.
Jerome, so let's talk about also this rotation that's happening. In south of the border, we're seeing, investors or hearing about rotations away from tech, yet the mega cap companies or U.S. tech still dominates index performance and flows. Do you think this is a meaningful shift, and does Canada, or is Canada going to have its own version of that rotation given some of the sectors that have been leading this year? Yeah,
well, gold's been a fantastic performer this year, as is the banks. And so you ask yourself, do you really think you're going to get re-rating further in those two sectors? So I think money comes out of them, and where do you look to? And oil and gas is one area which we think is attractive. I think in the short term, the next quarter or two, we're probably going to see the oil price come off. But for our purposes, we can hedge that out. But the market seems to be looking forward in oil and gas stocks. I'm surprised, given the weakness in crude oil, that the oil stocks haven't come off harder. And they've played a little bit of catch up in the last few days. But I think oil is interesting. And when you look at the weightings, we did an analysis of the top 10 actively managed Canadian equity funds. And this is about 9 months ago. And their average rating was about 6% weight in the oil and gas stocks. And they were concentrated only in the top 3 or 4 names there. So if they go to an 18% weight, which is what the index is, that would be a phenomenal increase in investment in the oil and gas space. And so we think if the flows go anywhere, we're going to oil and gas.
When I think, I've been surprised too at the fact that we see crude oil coming off in some of the Canadian majors. I mean, they'll move a little bit with the price, but they've sort of held in better too than I was expecting. Is this a reflection of cost discipline in the industry? They've been through this a couple times. In the end, do they just need a lower price for a barrel of crude? They can withstand that and still be profitable, a lot of free cash flow?
Yeah, I think it's the fiscal discipline that's come into the industry, and it's been happening for a decade. When we basically stopped investing in the resource sector back in 2013, partly because we were tired of the ESG movement and the impact that was having. And the other is it was very clear that the banks were pulling back in their exposure to the sector, which was going to make things a lot tougher. And they went through a very rough patch for a long time, but they became leaner and meaner and more efficient. And now they've got this newfound fiscal discipline within the sector where they're not spending like drunken cowboys every time the oil price goes up. And so that's great to see. I think it's great for Canada. And I think it's what really made the market interesting. So about 3 years ago, it was so compelling, the fiscal discipline, that we decided to break our self-imposed ban on resources, and we started investing in oil names. And so we basically only own oil, and a few months ago we added one gas name, largely because it's a conservative way to play gas in Western Canada.
All right, Jerome, so moving away from liquid gold to actual solid gold again, I just wanted to get your take on it. So gold's now trading about just north of $4,000 an ounce. It's had a historic run. You know, some market analysts are predicting at least getting up to 5,000, and it really does serve as a hedge. So do you think that the position is becoming too crowded at these levels, or is there further upside still on the cards?
I'm probably the worst person to ask about this because we haven't invested in a gold name since 2013, so I honestly don't have a view on it. If you ask me somebody asked me the question, what would it take you to get back into gold or mining? And I said, I can't think of anything, to be honest. I just hate the sector. It takes you 30 years after you find something at minimum to go from discovering a potential mine to actually bringing it in production. I just don't have the patience for that. I'd much rather, invest in an oil and gas company where I can get a payoff potentially in the Clearwater, for example, in potentially 6 months.
Okay, let's talk about, so you said at the top, of course, because we know in 2026 that CUSMA, USMCA, the new NAFTA, whatever you want to call it, there are going to be renegotiations. You're saying Donald Trump, and we've seen this style before, there's going to be some bumpiness, some turbulence, and what it means for manufacturing in this country. We don't have a lot of discussions about manufacturing when we talk about some of the issues that we're facing. Is this something that the market's overlooking, they're not adequately pricing in that risk?
I think they were paying a lot of attention in April about that, and so that fear is going to revisit itself in 2026. And so I don't know when the negotiations start, but when it does, they're going to put a target on the dairy sector, and frankly, it could be fantastic news for Canadians as consumers to get rid of the subsidies that we're effectively paying the dairy sector. Our beef farmers can compete on their own. Why is it that our dairy farmers can't? And, Trump may actually, much as I hate to say anything positive about the man, but he could actually do a favor to Canadians if he actually pushes to eliminate the dairy quotas. Similarly, there's other sectors of the economy that he could push on. I think there was a rumor yesterday talking about the beer industry, for example. Again, we pay at least double the prices Americans do for beer. Canadian consumers could benefit from that too. So there will be some things that we haven't really paying a lot of attention to that could come to light in 2026.
Okay. Jerome, I'm going to dig deeper onto coming back to the equity conversation. Is you've noted that there's real opportunity in being underfollowed in the Canadian mid-cap space. So if I were to ask you, what characteristics should investors be looking for right now? And is there any specific balance sheet metrics that matter the most when you're analyzing or looking for opportunities in the mid-cap area?
Well, I mean, you're spoiled for choice because no one's paying attention to it right now. Like, none of the pension funds it's been decades since they've invested in Canadian mid-caps. And so there is a trickle-down effect that happens when the pension funds eventually look at it. They take out the larger institutional funds, and the larger institutional funds take out the smaller ones who took out the retail investors. That's all gone, that hierarchy. And so what you get now is you get some quality names that people really aren't paying attention to. And I think there's a lot of companies out there that have very solid balance sheets that are trading at a fraction of the valuation of their larger cap peers, and it's strictly a function of how many eyeballs are looking at these names and who's a potential investor. And it's not only that at the institutional level, it's at the retail level as well. Like, I went to a couple small mid-cap conferences this fall, and look around, there's no one under 50 at these conferences. And it's kind of, I call it the CFL problem. When all of your fans are over 50, you've got a problem, because somebody has to come in and replace this. And there's guys there that are in their 70s, and you go, okay, how much longer are they going to be investing in small cap and mid cap? You need to get people excited about mid caps, and you got to get some returns. And what we're seeing instead is these take unders where CEOs of mid cap stocks are so tired of having an undervalued stock that somebody offers them a 20% premium for a takeout, and they go, done. And that's why we get the hollowing out of the Canadian economy. And when you think about where we're putting our money as a nation, we're putting our money into the large caps, because that's how we're institutionally set up. And so they tend to be oligopolies or monopolies. They're not the most efficient companies out there, but that's where we're putting our capital to. And you come back to productivity in Canada, it's about how we allocate capital too. And I don't think no one's having that conversation, which is concerning to me.
Maybe that'll be a conversation that people will start to have in 2026. So I think it'd be fair to frame your outlook for next year as cautious. That would be fair. What would change your mind on that? What would you be looking at where you'd say, okay, maybe caution isn't warranted, 2026 is going to be better than I think?
Well, if the market rips, like, we were
Proof will
seeing.
be in the pudding, right?
Yeah, no, we went to a bunch of conferences in early January, and we thought Trump was going to put, like, we asked, it was mainly oil and gas conferences, and we asked the executives there, do you think Trump's going to put tariffs on oil and gas? And to a person, they all said yes. And we said, the street doesn't believe that. So we literally came back on Friday and sold all of our oil and gas exposure, and we ended up buying it back later on. But just how the market ripped after April is astounding. So if it goes up, it'll pull the mid caps up as well. And so we have to follow what the market sentiment is out there.
Jerome, it's great to have you here today. Lots of great ideas there for our audience to chew on. Look forward to future conversations.
Thanks for having me.
That was Jerome Haas, Portfolio Manager with Lightwater Partners. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only. It should not be considered investment advice or buy, sell, or hold recommendations here. And as always, lots of stuff to dig through there. Jerome's saying a lot of really interesting things. I picked up on the oil and gas stuff because myself, I've been looking at it saying, well, you see the price of crude go down and down and down. There's been a little bit of reaction, but overall, perhaps some opportunity in 2026 when it comes to for the Canadian investor.
Yeah, Greg, he summed it up nicely at the end there. Just you have to follow market sentiment. And when you think about what our Canadian landscape is, we're very heavily skewed on three sectors: financials, materials, and of course, energy. Now, you got this year, what's shaken out, of course, is on the material side, you've had gold and silver that have had record runs, continue to have record runs, really tipping the scales, and skewing that market in our favor. But on the other side, energy, where oil hasn't quite fared in the same manner. In fact, it hit sometimes 4-year lows right now. So there's, based on what he said and at least what he's hearing from the street and different analysts and firms out there, there's a little bit of upside potential that could be that's on the cards when it comes to oil over there. I'm also intrigued about customer, Greg. I think, with this year, 2026, hopefully we can have some meaningful dialogue and move that dial up a little bit. But, I think he said the party's just getting started. Did I hear that he said beer could be cheaper for Canadians? So I'm sure that's going to ring true for a lot of folks there. Good way to bring in the new year if it happens sooner.
I think you can win elections on that kind of stuff, cheaper beer. All right, if you at home have a question for our guest or team, here's how you can get in touch with us. Just email us at td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free by opening a practice account. Just click on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export the workspace and start trading for real. Time now for more technical take on what's happening in the markets, and that is here in Naveen's place. You're sticking with the Canadian theme, taking a closer look at EWC. This is the Canadian Index ETF.
It is indeed, Greg. Yeah, we're looking at the iShares Canada MSCI index over here today. This ETF basically gives you the performance, gives you exposure to about 84 large and mid-cap Canadian companies. And you know, I just mentioned it, we have a very much heavy concentration in financials, energy, and materials that really make up two-thirds of the fund. A lot of the returns that we have in our market, of course, is very much tied to the commodity cycle, the metals complex structure, interest rates that we have, and then just global demand trends and for resources out there. So we know that raw materials, there's, you know, talks on the street that we're, you know, there's going to be another cycle of raw materials that we have. Gold and silver still are making new highs. I also wanted to take a look at valuations, because the valuation conversations is taking place quite a bit on, you know, south of us, with the S&P reaching these you know, eye-watering valuations likened to close what the bubble was back in 2000. But over here domestically, you know, the TSX sits just shy of like that, just under 20 or so. This specific ETF is about 22.75, just because it's giving you about 84 companies exposure there. So that's one to consider when you talk about valuations. They're not really stretched in the Canadian, unless there's a few sectors you want to really parse through. But let's actually go and see what 2026 holds, just on the way the charts have been shaking out over here. So what I've got is we're looking at a one-year look, essentially. We saw coming into those April tariffs, Liberation Day, you know, we were really on a downtrend, a significant downtrend. We did turn the corner as soon as we came out of those Liberation Day, entering into May, and we started a new bullish channel over here. You can see it's very much intact. It's remained strongly, the momentum has strongly favored the bullish run over here. We've seen it very much respect the channel as well. We look at the upper boundary and the lower boundary. You can see every time it tags that upper boundary, it rejects off of that, but it's also respecting the lower boundary. We've had 1, 2, 3 touches now, and we've had about 4 touches on the upper boundary as well. So if this continues to hold, we could see it hit again new all-time highs. It's already broken all-time highs. But one thing I just wanted to point out, whenever you have a strong trending, you know, momentum building up, it's always good or healthy for the price action to take a little bit of a break. We did see a bit of sideways action here. We call this a triple top formation, Greg. It rejected off of this key, what was, I've labeled it support, but was resistance previously for the 5150 level. But just recently, or start of end of November, we did break past that support or that resistance, which now becomes support at 5150. So this is the level now to eye to the downside. You have the 21-day moving average in the yellow that's really acting as the key support. It's respected that throughout the last you know, 6 months there. So on the downside, you have 5150 where it could bounce off of that. And the upside, you want to crack 54 to start another renewed leg up there. So that's one to keep an eye out for.
All right, nice to get a Canadian flavor into the show. Oftentimes we don't on TD Actor Trader Live, but now we're going to take a look at SanDisk. Walk me through what you're thinking here.
Yeah, let's talk about SanDisk. So this is a company, you know, you mentioned off the top, Greg, Micron, which deals in memory storage. So SanDisk is one of its competitors, and in fact, it's got a sympathy trade just because of Micron's numbers that came out after the earnings, and it's had a bit of a leg up there. But they develop, manufacture, and you know, provide storage devices and solutions based on NAND flash technology. Now they produce solid-state drives, memory cards, USB flash drives as well. They actually had an interesting story because they actually got spun out of Western Digital, which is WDC. So their focus solely is on the NAND flash technology to compete against the likes of Micron. They also had another leg up, and I'm just going to bring the charts up for SanDisk for a moment. What I've got is the 4-hour chart we're looking at. We're taking a zoomed-in view a little over here, and back on November 28th. The stock had a bit of a leg up. You can see coming into it, they got included into the S&P 500. So they, you know, and once you saw that, that meant that a lot of funds had to, that were tracking the index, had to go into a bit of a shopping spree to add and reposition their portfolios there. But a lot of soaring demand for this energy space for the AI. So there's a lot of things that are, you know, tailwinds for it. They came out with forward management just had their earnings, and they came out with some rosy outlook for the Q2 expectations in that 3 to 340 range on the EPS side, which crushed, you know, market's expectation of $1.77 on the EPS. So looking at the trend, though, we have seen that it's had quite a bit of a meteoric rise. You know, if I look at it, if I take out, if I go earlier on, you can see the strong bullish momentum and channel. It broke out of the channel into sort of a new leg. But since sort of November, when we had a bit of a tech shake-off, we saw it's become very volatile. And keep in mind, this is a 4-hour chart. We did have this massive sell-off over here. This was when the tech sell-off happened and rattled the markets. We did see SanDisk drop about 20% over a single trading session over here. So this top level above, the 255, that is the key overhead resistance which it needs to crack before it starts another leg up here. We also see this big telltale ace or symmetrical triangle formation that's formed. Now, what this pattern really tells us in technicals, Greg, is it's still forming right now. You know, if it plays by the script, we should see it bounce within this space. And this pattern can be either a continuation signal for us or a reversal. It really depends on which side it breaks to, the upside or the downside over here. Right now, with some green candles that I'm looking at, it fairly looks like there's strong momentum building up again. We could see it retag and test the 240 level. It'd be interesting to see if it can crack the 240, and then it's on its way to 255. On the downside, if it does break below this pattern, we could see it test that support at 190, which it's rejected off of previously, and we've seen demand shore up anytime it's touched that level there. So that's one to look at, Greg.
You've done all that hard work. It's only natural now. We should probably look at a couple ways that we could trade SanDisk. Before you get started, though, here, and I just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Take it away. Show us. Where do you want to start, bear or bull?
Let's start with the bull case first. I've got that lined up over here. So I wanted to fixate everyone on the charts here. So if you do have a bullish view, especially if you believe that this is a sort of a bounce off trade here, then we're looking at these key support resistance areas before it could get rejected off of there. So one way you could trade this stock, now given how volatile it has been, is by doing what we call a long call condor strategy. Now this strategy does involve 4 different option legs as part of it. So let me talk you through it. So one thing I've identified is kind of nearing that support area, which is this 200 level. So we're going slightly in the money to buy a call over here and look for some upside. And we're looking to sell a further out call, which is the 240 strike, which we identified just previously as kind of an area of resistance, which the stock has rejected off in the last couple of months over here. Now, the problem with this trade and why I've added another spread as part of it is just because it's very expensive given the volatility. So I want to reduce my overall, cost that I have for this trade. So what we're going to do is further sell what's called a credit call spread. So we're going to skip about 20 points out from that resistance area, go to the 260, sell a call there, and buy a 300 call further out to keep the distance very similar, or exactly the same, I should say. We're doing a 40 width spread on each of these legs that we have. So the combination of basically a debit spread and a credit call spread is what gets you a long call condor there. Now, what that means is it's reduced our cost. What would have cost us close to about like $30 by doing just a debit call spread is now down to about $9.50. So in other words, our break-even price is at $209.50. So the stock needs to get to that price at least for us to break even, which it's, given today's price action, it's well above that, given the trade with Micron's earnings yesterday. And I know you're going to ask it, Greg. I kind of teased it out at the bottom over here. How much do we make?
What's the risk?
We'll get to the risk. But the profit is essentially we want the stock to come to sort of a stop at the 240 level. Or if it crosses over 240, we're still making the max profit. And the way we figured that out is you just take the spread that we have, which is $40. We subtract how much we're paying for this, which is $9.50. And if my math is correct, then it's $31.50, or in other words, $3,150 is what we stand to gain on a single contract there. Now, the risk, of course. What if the stock actually does a dramatic, reversal from where it is right now and drops below? So one is we're going to start losing money if it stays below 209.50 by our expiry date. Now, keep in mind, we are giving ourselves a lot of time here going into the March cycle, so roughly about 100 days. And if it doesn't reach that price or stays below 200, which is the worst case scenario, then we'll be out. What we paid, our capital outlay in this case, is $950 on a single contract there.
Isn't it terrible how I go to the risk all the way? I want to hear the reward, too. I got to start looking at the rosier side of life, the 50-50
That's what we start
of it
with
all.
usually, Greg, yeah.
All right, so that was the bull case. How could a bear possibly play it?
Yeah, I'm going to get a little bit of finger wagging on this. It's unconventional, but I've actually got a credit put spread trade on with a bearish lean to it. colloquially, when you talk about this trade, most traders would consider this as a neutral to bullish trade because you expect the stock to go up. But I do believe that there's a bit of downward pressure, and this is why I think it's a good opportunity given the volatility profile that you want to collect some income. So the way we've done this trade essentially is, again, we looked at those key levels and we found that every time it's come around this level, the 190, the stock has found buyers stepping in to buoy up the price, or there's demand at these levels. So what I'm looking to do is exactly sell at that 190 strike put. We're looking more near term. So we're looking for the January cycle because we want to take advantage when it comes to options of time decay here. And we still want to protect ourselves to the downside in case the stock does, break below this 190 by going and buying the 170. So we've defined our risk at this point. We're doing $20 wide spread on this one, and we're collecting premium. So in this case, we're going to be collecting, it looks like about $6.50. I'm just going to extend this out here. So $6.50 is what we collect right at the onset of this trade. Now, the way the trade works is we want SanDisk to stay above $190, at least by our expiry date. If that happens, we get to keep the $6.50, or in other words, $650. That's our max profit on this trade whenever you're doing a credit spread. It's whatever you collect up front when you put the trade on there. Now, this is where it gets a little bit blurry when it doesn't play by the script again and falls below 190. We're okay up until the 183.50. That's our break-even level. We'll still be profitable, maybe not as profitable as it's staying above 190. But the further it breaks below that, we start incurring a loss in this zone. And of course, if it breaks below 170, then we'll realize a max loss situation. In this case, again, the math works very similar. You take the spread, which is $20, minus what we collected, $6.50, and that equals to $13.50 is our loss. In other words, $1,350 on a single contract, Greg.
All right, some interesting ideas there for our audience. We're coming near the end of the show, not only the show for this week, but for 2025. It was, the years go by so fast. So obviously we've been doing TD Active Trader for more than a year, but it was only this year we went to 2 a week, right? It was just like after Labor Day we started doing the Thursday show,
just
right?
after Labor Day. It's been a storied run, of course, with Active Trader and then bringing this show on. So it's been a great year. Looking forward to 2026 and bringing the new year in with some more insights that we can give to our audience here, and then probably some more technicals as well that they can chew on there. Give some
a lot
ideas.
more to come, and who even knows if the people who put this, who back the show for us, I think they want even more. So who knows how many days a week? Right now I'm freaking out the producer because I don't know. I'm just talking off the top of my head. And also, at some point, I'm on TD Direct Investing's Instagram page right now. I don't see it yet, but we did a shoot earlier this week with Jason Maddock. There's going to be a little TD Active Trader Live Christmas card coming out for the fans.
We got some Christmas cards for everyone. I think they're going to enjoy it. So I'd love to see what the comments show up like. So if you are going to see them, join us on Instagram, subscribe, and you'll see some of our holiday cards for everyone there. And a little bit of fun banter in the comments. We'd love to read as well.
All right, great stuff as always. Thanks for that here, and that's the show for this week and for 2025. Investors, as always, should perform their own due diligence before engaging in trading. We will be back in January, fresh debates and new guests. Thanks for watching this year, and we'll see you in 2026.